Hello and welcome to Value Research Podcasts. You are listening to Money Masters, a series of interviews where our host, Dhirendra Kumar, picks the brains of India's top fund managers. Stay tuned for some thought-provoking discussions.
Thank you, Saurabh, for joining me for Money Master and seeing you evolve into a Money Master. So this is a slightly elaborate interview where I want to know everything which I've been curious about. So I'll just I've been curious about, and I'm also asking some question about which the answer I know, but I would still like to ask those questions for benefit of our viewers and listeners. So getting started in investment, tell me about your beginnings in the world of investment. Did you ever consider, pursuing a different career path?
My beginnings in the world of investment. I graduated from the LSE in 98. Around the turn of the century, I was sent by my then employer to the UK financial regulator to help the regulator roll out a new rule book. I was the economist advising the regulator on what the rule book should and shouldn't contain. That's where I met other people who had the CFA designation. I had never heard about the CFA designation, the CFA charter until that point. I then passed the CFA charter by studying up and down on my local train journeys through 2000, 2001, 2002, 2003. And I quite enjoyed, studying for the charter. That's when I realized that, it'll be good fun to become an equity analyst. I saw an advertisement in the local financial newspaper for the City of London, newspaper called Financial News, that a group of young analysts were setting up a equity research boutique, and they were looking for people who wanted to become analysts. I applied there, and they interviewed me for 5-6 hours, and they hired me as their financial services analyst. So 2003 November is when I entered the world of equities. The initial years were reading the usual books. Peter Lynch's One Up on Wall Street, Warren Buffett, Roger Lowenstein's book, Buffett, The Making of an American Capitalist, trying to understand securities analysis, and Benjamin Graham, and coming to grips with the basics of equity analysis and valuation. I have to concede those early years were so enjoyable, so much fun, that once I got the hang of equity research and the stock market, I never really considered an alternative career, right? I enjoyed writing. Equity research gave me a means to write. And as I wrote more and I sort of found my feet as a writer and a thinker, authoring books became a sort of parallel hobby more than a profession. And by the time 2013 came along, a decade into my career in financial markets, I was authoring books and analyzing companies by that time across multiple countries.
So was there any specific experience? I'm talking of your earliest years of, getting into this career, or, finding your way, inroad into this. Was there any, any great influence in your approach to investing, or any big influencer there?
In terms of people who have influenced my thinking on investments, as I said, the early influences were the sort of the usual legends, Buffett, Lynch, Ben Graham. But as I got to grips with the job of an equity analyst, I realized that understanding comparative advantage in great detail, understanding comparative advantage in granularity is a big skill. And for better or for worse, none of the legendary investors have spelled out how to do this. Even the great Warren Buffett, whilst he coined the memorable term moat, there isn't a great deal of detailed articulation from Warren Buffett on how exactly do you find a moat. This is where the great British economist Sir John Kay, his book, his work, meeting him, working with him, proved to be incredibly illuminating, incredibly enlightening. So John wrote a book in 93 called The Foundations of Corporate Success. That was my initial Bible on understanding comparative advantage. And as I got to know John a little bit over the years, I realized that the 4 pillars of understanding comparative advantage: innovation, brand, architecture, strategic assets, what I call IBAS, That's the best way to go about analyzing competitive advantage. And I've written about this in my own books, Diamonds in the Dust, Unusual Billionaires, and so on. So beyond the legendary business gurus, John Kay was a very powerful influence, and the other early influence and still an abiding influence was Terry Smith and the work he's done on forensic accounting. So around the time I was finding my feet as an analyst, Terry Smith's book Accounting for Growth was in print. It was incredibly influential. I enjoyed it. I read it several times, underlined it heavily through pen and pencil. Accounting Group for Growth was basically a forensic accounting book on the UK stock market. Terry outlined how prominent British companies had fudged their books through the 80s. And in a way, that was the kind of the beginning of the legend that Terry Smith has become. Now, obviously, his firm Fund Smith has become a legendary investment firm. As I grew a little bit more mature as an analyst, I realized that Howard Shillett and his team in America do tremendous work on forensic accounting, and their book Financial Shenanigans became one of the sort of frameworks, one of the mainstays on how we conduct forensic accounting research in India. So Terry Smith and John Kay, I would say, have been the two most powerful influences on how I've thought about equities beyond the initial gurus.
Yeah. So how did you move from there after winding up your, selling your startup, so to say, and then sell side in Bombay?
Right. So whilst we moved to India partly to give our children an upbringing in India, I'd also moved to India, Dhirendra, because I realized there was an opportunity in the country. I had seen some of the Indian small cap equity research, and I felt that my colleagues and I could do better research on Indian small cap names. When we arrived in India, we realized that there was plenty to do on the accounting front. And having built a forensic accounting model in our opening months in India, as I mentioned, we were able to spot the Meta Satyam fraud before it blew up. That itself gave us a rudimentary franchise amongst foreign investors and the domestic mutual fund houses. But as our name grew and as Ambit reached out requesting us to join them and build their institutional equities business, we realized that there's a couple of more nuances to working in India beyond the accounting issues. The accounting issues, the fact that a developed market like the UK has fewer accounting issues than the India of 2008, I suppose that's an obvious point in retrospect. But there was a couple of other more subtle issues which we had to deal with. The first was nobody in India says no to anything. So if you ask the promoter, do you have a capex plan for the next 3 years? Obviously, he'll say yes, right? He's not going to say, I don't have any capex plan. So you have to just learn. We had to learn which yes was a real yes and which yes was a fake yes.
Fake one. Okay.
Right? That took us a couple of years of trial and error to get the hang of.
Give me an example of that.
So this was so in a way accounting issues contributed to figuring this out. So it was 2010. It was 2010, Dhirendra, and Crompton Greaves at that time was a blue chip stock. Crompton Greaves was a blue chip stock, and all the famous fund managers in Bombay owned it. And as you can imagine, the capex cycle on TND stock. But we would read the annual report and see related party transactions, right? And we would question the logic behind the related party transactions. We would question the CFO, for example, about the logic behind the related party transactions. And I remember there was a private jet. There was a private jet that the listed entity was paying for, which wasn't owned by the listed entity, it was owned by a promoter entity. Okay. And we couldn't quite rationalize the pricing. So obviously the CFO assured us that pricing bilkul theek hai. We would ask questions like, are you sure the
pricing and everything? So
yeah, absolutely. And he would say, you can imagine what he would say, right? Yes. Right. That's when I realized that even when someone very confidently says yes in India, you got to go back and do your own homework on what's transpiring here. So that was the second sort of subtlety. And the final aspect was it's a vast country, far bigger than the UK, right? Far bigger geographically than the UK, culturally diverse. And we realized we had to build an extensive network of primary data contacts. And it wasn't just good enough to know, 50 people in Bombay. Right? In the UK, if you know 100 people in London, you're pretty much sorted. But in Bombay, in India, if you know 50 people in Bombay or 100 people in Bombay, that's not going to take you very far because you also have to have contacts in Chennai, in Coimbatore, in Bangalore, in Delhi, in Kolkata, in Ahmedabad, and so on. So building out that network.
Count Hyderabad in this, is any special reason?
Right. At that juncture, we were obviously a little traumatized by our early experiences with Satyam and Metas.
Mm-hmm.
Subsequently, we realized that Hyderabad today and Hyderabad of 2008 is a different beast.
Mm-hmm.
But that building out that contact network took a few years. Once these things were settled down, we had got our forensic accounting act together. We had figured out how to read people beyond what they were superficially saying, and we had figured out our contact network. It became a lot of fun. The Ambit franchise started gaining momentum. 2013, 14, we started getting very highly rated by domestic and foreign investors. And that was in a way the making of us, the making of Ambit's equities business. So looking back at those, the years, basically the years running up to Prime Minister Modi coming to power, those were
Mm-hmm.
formative years for us in India. And
Okay.
we worked very hard. Most of us used to do 12, 13-hour days year after year, but it was tremendous fun, just understanding this vast, complex economy.
Mm-hmm. Now, I'm just becoming curious about your research, the framework of spotting, the financial creativity or the engineering or
Mm.
fraud. What are typically this? Related party transaction is one, cash flow not matching. Give me some broad framework that you actually
Sure.
look up to.
Sure. So let me just broadly break it up. There's some quantitative metrics that anybody can look at, and there are some qualitative metrics, right? And we've laid this out in a basic manner in Unusual Billionaires. And
Okay.
then more recently, Diamonds in the Dust, we've laid this out quite extensively. So the quantitative metrics are, for example, if the translation of operating profit to operating cash
Mm-hmm.
is inferior. So for example, 100 rupees of operating profit is only becoming 60 rupees of operating cash flow, right? And if other players in that industry have a better ratio, then that is a worrisome factor. Why should one pharma company, for example, have an inferior cash conversion ratio compared to other pharma companies with similar franchises?
Mm-hmm.
Then staying with quantitative metrics, if the growth in auditors' fees is inferior, if the growth in auditors' fees is more rapid, if auditors' fees are growing faster than
Mm-hmm.
revenues,
Then
that should also raise a, and I'm saying this is over 5, 6 years. Over five, six
Mhm.
years, if you have a large listed entity where the audit fees are absolutely galloping away, but the revenues are not, then that should raise a red flag, right? So in this vein, Dhirendra, there are around dozen odd forensic
Mhm.
metrics that we created, and we published this in Diamonds in the Dust, and we've translated that into Python code that we apply every year. But there are qualitative metrics as well,
Mhm.
right? Perhaps the most powerful one is the audit disclaimer. Right?
Mhm.
In the audit disclaimer, the auditor basically gives you pretty clear signals as to how comfortable he's with the accounts, right?
Mhm.
And if the auditor himself is saying that, look, and there's a couple of very powerful soft signals that auditors give when they're not comfortable with the accounts. The first one they tend to give is, oh, these items, the company has given us data. We
Mhm.
have taken it at face value and signed off. The auditor will say this pretty clearly if that's the case, right? The second soft signal they will give is 50% of revenues or some very high proportion of revenues, they will say, has not been audited by us.
Mhm.
It's been audited by other auditors, and we've taken their audits at face value, right?
Yes. Okay.
If you have both the soft signals, then
Mhm.
that's a pretty powerful red flag. And therefore, the audit disclaimer, it's only 300 words, but it's worth
Yeah,
reading
yeah.
quite carefully.
It's yes with a no. So kind
It's
of.
yes with a no. That's right.
Yeah.
Yeah. So that's lovely. Yeah, you said. So by the time I figured this out, I'd understood the coda for communication in corporate life, right? An equally powerful signal is the audit partner's track record. So every annual report, the audit partner's name and his CA institute number will be given. What we have found very useful is to check out what other companies does the same auditor audit. And if you find an auditor who either doesn't audit any other listed entities
Mhm. Mhm.
or audits other listed entities with a shady track record,
Mhm.
right? That itself is a powerful signal that you and I need to be
Okay.
careful here.
Auditor's analysis is another dimension to this.
Absolutely. The auditor is a very powerful signal. And
Mhm.
for better or for worse, there are certain auditors we've realized over time, their name on the annual report means khatre ki ghanti
Mhm.
ringing loudly in my head.
They are the risk themselves. Okay.
Yeah, it's more than the firm. So a lot of people say, "Ye firm, wo firm." The firm more powerful than the firm is the auditor's personal track record. The firm is useful as a useful signal, but the auditor's personal track record tends to be a very powerful indicator of corporate governance.
So you have been at it for now very interesting times, 2004, 2014 Modi government, and then the GST. GST led to, accounting being done in a manner where things can't be really deferred, or you can't really do creative engineering, accounting beyond a point. Things get recognized and government gets into the picture on an ongoing basis. It is not subject to annual settlement or annual adjustments. So do you see any impact of this on the corporate balance sheet or the
Yeah,
P&L?
I think there are three steps that have been taken which have very significantly improved audit quality in India, right? Between I think 2008 to 2020, 24, vast improvement, three significant steps. First is, as you're saying, the nature of the tax system itself has changed, right? And that's reduced these bizarre tax issues that we used to deal with. The second is the government has created an auditor for the auditors, right? There's a government created body in Delhi, which now scrutinizes the audit profession. And there is a whole bunch of legal sanctions that have been applied on errant auditors, perhaps to their chagrin. But I think as a interested bystander, I'm quite pleased about the audit profession is being held accountable by the government of India. And the third area is, I think the regulator has also moved in quite aggressively to crack down on companies who publish misleading accounts, whose quarterly statements are not a fair representation.
You mean
of
SEBI or MCA?
I have less visibility on MCA. I think the MCA piece I would give credit for the scrutiny of the audit profession. From what I've seen and read, the MCA is the arm of the Indian government responsible for holding the audit profession accountable. SEBI, I think, has done a pretty good job of saying that you cannot publish quarterly results which are meaningless, which don't have any correlation with the final year-end results, right? The overall environment, therefore, especially for investing in small and mid caps, has become far better today than it was 10, 15 years ago.
All right. So now I'm getting to the meat of our interview, which is, what, in your opinion, are the essential qualities of a great business? Of course, I came to know about your work in great detail after reading Unusual Billionaires, the advanced copies. And I liked it so much that, at Value Research, we started selling it to our users. And that would have contributed quite meaningfully to it, that becoming a bestseller. So
thank you so much.
But still, for benefit of our listeners, what in your, how will you articulate, the essential qualities of a great business?
No, so we just tell you, harking back to Unusual Billionaires, right? That the 2.5 years spent writing that book was a big learning experience. It was part of our kind of for the formation of our thinking in India. So I'll not get into the forensic piece. I think in a way that we've already discussed that. Leaving aside clean accounts, the first great sign of a successful business is a long track record of steady revenue growth alongside healthy return on capital, right? So I call it a kind of Rahul Dravid type companies who are there decade after decade, over at least a decadal cycle, double-digit revenue growth, which I think is a very fair ask given that nominal GDP growth in India is at least 10% usually, and pre-tax ROCE being at least 15%, or rather, if you want to look at post-tax ROCE of 12%, which means your ROCE is above cost of capital, right? It still amazes me how few companies in India pass this basic test. And I think one of the things I have learned over time is even fewer companies in China pass this basic test, actually. So this is a very powerful test. You can apply it in any EM. Double-digit revenue growth, 15% pre-tax ROCE. I think that's the basic definition of a successful company, right? Longevity. Then we come to the slightly harder part, right? Broadly speaking, these are accurate numbers, so I'll use broadly these numbers. Roughly 50 to 60 companies in India, Dhirendra, will pass this test, double-digit rev growth and 15% ROCE. The harder part is to figure out of those 50 odd companies, which are the dozen and a half companies which have overwhelmingly powerful comparative advantages. Now, the reason this is hard to figure out is the companies who have overwhelmingly powerful comparative advantages don't like to shout about it from the rooftops. They keep it sort of, well, I'm not saying they hide it, but they don't like talking about their strengths, right? And they tend to do very boring quarterly conference calls, and they come on broadcast media. They will make banal statements which sound completely, uninteresting. But it's these companies where the real wealth compounding in India lies. So, Unusual Billionaires, and if I hark back to that book, say the chapters on Asian Paints,
Budget paying.
Astral Poly, Berger Paints, HDFC Bank,
Mhm.
and it's even now, right? I still tell myself how remarkable this country is. We wrote that book 9, 10 years ago,
Yeah.
and even today these companies are compounding at around 20%, right? And the reason for that is we were able to figure out whilst writing the book is just because Asian Paints or Astral Poly or HDFC Bank or Berger Paints are not flamboyant companies doesn't mean they're anything other than utterly dominant in their industries, right? So understanding the nature of comparative advantage, the depth of comparative advantage, aligning that to stable, robust financial results, you bring the two together and you have basically a champion company. And as I've said in several of our books, you invest in these and stay patient and ride the wave of growth that is sweeping through India.
And they become sustainable by the very design.
In a way, the sustainability is inherent in the DNA. The promoter has evidenced a stable, rational frame of mind to stay the course in one large industry. Often they will jump to adjacencies. They will jump to adjacencies and pick up adjacencies very capably. And that's the only way, right? If you think about it, it sounds obvious when I put it like this. If you stay the course and focus year after year on the same industry, that's when you're able to build overwhelming comparative advantage. If you do 20 different things, you're unlikely to build comparative advantage in anything, right? But if you are doing paints for 70 years or pipes for 20 years or jewelry for 40 years, it's highly likely you'll do it better than someone who's been doing it for 20 years.
When you do this exercise and you end up with a very narrow universe, how do you go about valuing it? How difficult it is?
Right.
Everybody knows there isn't a secret.
Yeah. So let's discuss that. And it's just a quick disclaimer, all of these stocks that I'm referencing, they sit in our portfolios. I am an investor in Marcellus's portfolios, so are my parents, right? So let's address the valuation issue, right? So if you ask me this, between leaving the UK and whatever I knew of investing there and writing Unusual Billionaires, this was the big sort of intellectual leap that my colleagues and I were able to make. So I'll just simplify it, right? If you think of a basic DCF, if a company grows cash flows at say 20% for 5 years, and thereafter it becomes a perpetuity, say a perpetuity compounding at 5% rate of inflation, perpetuity, right? So a five years of 20% growth, and thereafter a perpetuity, you apply a cost of equity of 12%, you'll see that the company shouldn't be worth any more than 25 P, right? So that's I would say bog standard, decent listed enterprise. Broadly market valuation 20-25 का ही होता है, 20-25 P का. That's a typical decent company. However, if the company, rather than compounding for 5 years, it compounds for 15 years at 20%. Cash flows compound at 20% for 15 years, and thereafter it becomes a perpetuity. A DCF will tell you even 70 PE is actually close to fair value, right? And if the same company, rather than compounding for 15 years, compounds for 25 years at 20%, right? 25 years of 20% cash compounding, thereafter a perpetuity, then even 150 PE is actually fair, justifiable. In fact, it's cheap, right? So the challenge for people like us, and indeed for other investors in India, becomes figuring out longevity. How long will the compounding continue? It is but obvious that Nestle or Titan is a great franchise. What's not obvious is how long does the compounding sustain? And And writing Unusual Billionaires, I stress again, right? We wrote that book effectively 10 years ago. It was published 8 years ago,
Mhm.
right? And anybody who feels like it can open that book and see the names of the stocks in that book and see how well they've stood the test of time. Writing Unusual Billionaires taught us is that if you devote inordinate amounts of time to figuring out the longevity of compounding,
Mhm.
it's a rewarding exercise. It's intellectually rewarding and financially rewarding, right? So longevity broadly has two parts to it, Devendra. Longevity of compounding has two parts to it. One is, does the promoter know or does the management team know how to do high quality capital allocation, right? And how do you assess that? You look back at the last 10, 15 years and you see how they've allocated capital.
Mhm.
Have they allocated capital in the right initiatives so that ROCE has actually consistently gone up? Or have they made a mess of capital allocation by moving into unrelated areas, doing capex which didn't bear fruit?
Mhm.
The second part of longevity is succession planning, right?
Mhm.
Because if I hypothesize
Mhm.
that Titan will compound at a healthy rate for 15 years, naturally the current C-suite of Titan would be long gone by then.
Yep. Yep.
Therefore, my colleagues and I have to spend a lot of time with the one downs to the current C-suite to see
Mhm.
what is the quality of the one downs,
Mhm.
right? And assessing the quality of HR, recruitment, talent management, mentoring, therefore becomes critical in the research
Mhm.
process, right?
Culture.
Now, neither of these judgments are going to be perfect, right? We are human beings. These are tough, complex judgments. We will get it wrong from time to time. But what Unusual Billionaires gave us faith is that if you devote more time to it than other investors are, you're
Mhm.
able to make more money than other investors can.
You're more right about those judgments.
That's right. You're more right about complex qualitative judgments because remember, arguing about agle quarter ka EPS
Mhm.
is an
Mhm.
argument that 25 different people are having, and I have no reason to believe I or my colleagues will get agle quarter or indeed agle saal ka EPS any more right than
Mhm.
55 sell side analysts will. But arguing about is the succession planning at HDFC Bank better than the succession planning at Bank of Baroda, I think that's a good debate to have because that's a debate where our access to our experience and our access to management gives us a point of view where we can be more right than most people.
Given that you know what you have done so far and Unusual Billionaires and the universe of stocks that you're focused on, so do you all these rewarding investment ideas, they have come from screens or there's personal research or delving deeper into these companies, and how do you expand this universe, or you will just have a defined set of companies and you don't expand that?
Right. So here there are two parts to how we work. One part is the companies that are like Unusual Billionaires, we call them consistent compounders,
Mhm.
Dhirendra. We call
Yep.
them consistent compounders. So these are companies with long proven track records of
Mhm.
ROCE and revenue growth. And because you're having to make a call on longevity, you're effectively having to do a lot of work on ये 15-20 साल ये machine fire करेगा यानी. A
Mhm.
different part of Marcellus, and this is something I figured out with my colleagues 6 years ago is small cap investing, right? In small cap investing, the framework we applied is slightly different, and a big part of the framework came from a book called Hidden Champions of the World, by a management consultant from in Europe, right? So the small cap framework is as follows. You're looking for companies with, say, market cap below, just to keep it simple, market cap below 10,000 crores. And you're asking yourself the following question, right? I'll do the quantitative first, and then I'll go to the qualitative. Quantitatively, you're saying in the latest 3 years versus the preceding 3 years, right?
Mhm.
Latest 3-year block versus the preceding 3-year block. Has this company's revenue growth accelerated?
Mhm.
Have their profit margins expanded? Have their asset turns improved? Has their working capital cycle improved? Therefore, has return on capital improved? And therefore, has free cash flow or been improved, or has debt been wiped out, right? So that's the quant framework, right? Because these are chota companies, you're not asking them to prove themselves over 10 years.
Mhm.
You're basically asking them to demonstrate improvement in operating metrics, right?
Mhm.
Profitability, cash flow, asset turns, and so on. On the qualitative side, what you're looking for is companies who could be small, but they are producing something which is a very essential part of a much larger industry. right? So it could be
Stable.
ceramic reactors for the pharma industry. It could be emulsifiers for the cakes and biscuits industry. It could be salmon fishing nets for fishermen across the world, right? So you're looking for companies who themselves are small, but they're producing something which is utterly central to a far larger industry. Secondly, you're looking for dominance of that company in that specific niche,
Okay.
right? Thirdly, you're looking at a history of sticky customer relationships. Fourthly, you're looking for a history of staff loyalty. And we've discovered over time, these are very correlated things. If you make something which is essential for a larger company, the larger company tends to be sticky. Your pricing power tends to be high. You tend to be profitable. You tend to pay your staff well. Your staff tend to be loyal. And if over and above this, there's an angle of intellectual property or licensing, then to sone pe suhaga.
Then you become Crisil.
Yeah, nicely put. Yeah, or of that ilk. So that's the small cap framework. This is in a way the small cap product. Little Champs is where we find the companies when they are nascent. We invest in them, stay with them for 4 or 5 years. As they grow bigger, if they show that they have it in them to be a consistent compounder, they graduate to the large cap portfolio.
Else you climb down. Okay.
Else you get out. Yeah, if you realize you made a mistake, and mistakes are mistakes are more likely in little champs than in consistent compounders. You get out without trying to lose too much money.
In your investing framework, based on what I've read and what I'm listening in this conversation, how important is meeting a company management? If you don't meet a company management, you won't go ahead, or you won't build a conviction, or has a meeting led to a dropping of an investment idea?
So in consistent compounders, honestly, it helps to meet the one downs to the CEO than the CEO itself. Because remember, in consistent compounders, you're making a call on longevity, and therefore you're trying to assess the quality of the next generation of management. In little champs and small caps, you're right, it does help to meet management because these are chota companies, and often the promoter of the chota company is also the CEO, effectively is the head of strategy, he's also the main salesman. And therefore, you're trying to assess broadly three things when you're meeting the promoter of a small company. Firstly, is the small cap company the whole and sole call on his time, or does he have three other enterprises? One fellow I met in Delhi, we actually held that stock until I realized that in the evening, he's focusing on selling space advantage to wealthy people like you in the NCR region, right? And once I realized that he's spending part of his time selling
Sorry,
tickets to
come back again.
space.
I couldn't. I really didn't pick it up. What was it
So
doing?
this was the owner of a small cap company that we had invested in.
Okay.
And we'd met him a couple of times, but in the third meeting, I realized that after he goes home from the office, he spends his evenings selling space adventures. So he's got the franchise of a specific company that sells
Okay.
rockets to go to space to wealthy people in the NCR region. And I realized that's what he does in the evening. Now, at one level, it's innocuous that
Yeah.
the fact that he calls up wealthy people in Delhi and says, for a few $1,000s, you can go to space, right? But another level, I thought that's not the right use of your time. You're running a small business in a competitive industry. Your employees will know about these extracurricular activities, and it suggests that you're not spending your time and effort growing the
Right.
listed franchise, right? So that's the first thing you're looking for is are the extracurricular efforts getting in the way of your running a high quality business. The second thing you look for is uh, uh, you look for how much he thinks about capital allocation and how much he's able to articulate to you why he's making certain investments, right? So it's all, remember, because of the way we are researching the small cap companies, it could well be that we are like monkeys throwing darts at a dartboard. We have picked up the companies who happen to get lucky over the last 6 years with their capital allocation calls. So therefore, when you're meeting a small cap promoter, you're trying to figure out, is this fellow just the lucky winner of the latest capital allocation draw in India, or does he apply serious thought and logic to how he goes about his capital allocation, right? So the moment you hear about all sorts of wild and racy thoughts on capital allocation, मैं ये भी करूंगा, वो भी करूंगा, कुछ और भी करूंगा, you start becoming a little concerned about will he blow the balance sheet apart in the next 3-4 years because he's so excited the last 3-4 years have worked out for him. And the last thing, obviously, you're checking for integrity. right? But a lot of people take related party transactions at face value. We have learned the hard way that a company can do related party transactions without calling them related party transactions.
Okay.
And we keep a keen eye on, given what we can see in the annual report about the promoter's income. Is he driving a car commensurate with his income? Is he
Mhm.
living in a part of Bombay, Delhi, Bangalore, Hyderabad commensurate with his income, or is he living a lavish lifestyle, which simply cannot be funded by
Is
what we are reading in the
owned by
annual
the
report?
company. Yeah. Okay. Mhm.
Yeah.
Uh, Now my next question, which you pointed to this in this answer itself, that how do you assess, companies' allocation decision? Can you provide an example, of poor capital allocation you have encountered?
So let's
A
let's
poor
yeah.
allocation sometimes, just stealing from the company.
So let me draw one more nuance, and I'll answer your question then. So the hardest nuance to draw is the company did the right thing,
Mhm.
but the cycle didn't favor them. So let's take an example. It's happening to us in Little Champs at the moment, so it's a matter close to my heart. So the year ending March 20, the year ending March 21, and even the year ending March 22, big parts of those fiscals were lost to COVID, and
Mhm.
therefore naturally profitable companies ended up with surplus cash
Mhm.
on their balance sheet, and therefore through the year ending March 23, we've seen a huge surge in capex
Mhm.
amongst many of our investee firms, right? And I think that was the right thing on their part. They pressed the capex button. Now, in the context of specialty chemicals, the Chinese have dumped heavily on India in the last 8 9 months. So
Mhm.
naturally, our investee companies in specialty chemicals who ramped up
Is it-
their capex through 22 23, they look stupid at the moment because they've got plants that have they put up. Either the plants are running at low capacity utilization, or if the capacity utilization is 60%, the profit margin is wafer thin, right? So it looks like it looks stupid at this juncture, but we don't penalize companies for that because to our mind, they did the right thing. They had high ROCE, which means high cash flows. They reinvested the cash flow because they assessed that there is scarcity in the Indian market. It's a different matter that the Chinese came and slammed us by
Mhm.
dumping capacity on India below cost. But that's not going to be a permanent state of affairs, and therefore we stick by that sort of capital allocation. Where we get a little worried is when a company that is supposed to be, say, specializing in FMCG, or say a specific subsegment of FMCG focused on South India, now
Mhm.
says, I'm going to do a different type of FMCG focused on Eastern India,
Okay.
right? Now, we also realize we're not so smart that we can tell the promoter that don't do this. This is a dumb idea. So
Mhm.
we give him a couple of years to say, ठीक है, आप कीजिए. You think it's a great idea to enter a new market in Eastern India. But if after a couple of years we can't see any evidence of Roki,
Mhm.
and our own channel check suggests that building competitive advantage in Eastern India in that FMCG product is going to be hard, and the promoters still persist throwing money at it, then we say this is not making any sense. Let's get out of here. So there are two distinctions to be drawn. One is you made the right call, but it hasn't worked out because of exogenous factors. You persist, but you made a call which looked a little iffy at the outset. Subsequent events suggest that the call should be reversed, but you still throw good money after bad. That's when people like us have to head for the door.
Do you think there is a likelihood of, this capital being burned, something like Meta Satyam or, Crompton kind of situation anymore in future?
No, I don't think so. I know for sure, Dhirendra, it's happening. It's the
Okay.
nature of a free market. You're going to see
Mhm.
that, right? Remember, Enron happened as recently as 20 years ago in America. And Enron happened after a 6 year accounting fraud crackdown by the SEC.
Mhm.
So that's the nature of free markets. You will see
Will have it.
companies trying, you'll see companies trying naughty tricks. I'm sure the regulator is vigilant. I'm sure investors are vigilant, but the promoters are equally clever, and therefore, all of us have to keep our wits about ourselves rather than getting carried away by this bull market and saying, "Arey, small cap bhag raha hai, let's also jump in and
Mhm.
buy some stock where the fundamentals don't suggest any support for the underlying stock price."
Tell me one significant investment mistake, you have made in recent times.
I mean,
And
there's several of them, but let's talk about the one which has been most publicized.
okay,
So we first invested in Relaxo 6 years ago,
okay,
and to give all credit to a very hardworking Dua family, which has built Relaxo from a tiny little company in West Delhi to a multi-billion-dollar enterprise.
mhm,
We still think they built a fabulous business, right? Um, in the low end, in the low ticket end of the chappal market, I don't think there's any other franchise comparable to Relaxo in northern and eastern India. Where we perhaps should have been more circumspect, more vigilant, is as the company grew, as the number of SKUs grew and the number of products grew, the geographically the company expanded. In fact, through COVID, the dealer count doubled. Through
okay,
COVID, the dealer count doubled. As all of that happened, we should have looked for more signs of professionalization
mhm,
of of
patient,
a family-run business,
mhm,
and more use of systems, process, technology. Because it's one thing to run a company largely centered around NCR with 100 SKUs. It's
mhm,
another thing to run a company with thousands of SKUs straddling northern and eastern India, and where dealer count is doubling every 3 years or so.
mhm,
That professionalization, the use of systems and processes, probably didn't happen in the way it should have. Maybe COVID was to partly blame, but we certainly deserve a degree of blame for not spotting that lack of upscaling of the franchise. Now, the result was because we were not vigilant through 2021, post-COVID, broadly saying 2021 being post-COVID, because we were not vigilant through 2021, and we hadn't been able to go and see them face to face through 2020 and 2021. In January 22, when Russia attacked Ukraine, that drove up the doubled the price of crude
mhm, mhm,
in the next month or so, right? So I think by Feb 22, the price of crude had doubled. Naturally, for uh, low-end footwear,
mhm.
petrochemical prices are a big part of the input cost. So
Okay.
the input cost doubled, and by March, April, we noticed that the prices of Relaxo's footwear have been doubled, right? We saw it on Amazon, we saw it in our dealer checks.
Mhm,
Um, and that was our submission to them was that was a strategic mistake, because what we have seen with firms like Pidilite, like Astral Poly, like Asian Paints, is when the price of the raw material goes up, the champion player who usually has the highest operating margin
mhm,
deliberately does not hike his product price. He takes a margin sacrifice, knowing full well that weaker players will be wiped out by the input cost inflation, right? There was a strategic call made by Relaxo to hike their product prices. That then let uh, two sets of competitors in. It let in competitors from South India, firms like VKC, who are strong in the South. They rode into the North, courtesy Relaxo doubling its prices. And also these, the informal players who melt doodh ka pouches, the plastic
mhm.
pouches for milk. The informal players, they melt that and turn that into chappals. Those guys also got a lease of life, because Relaxo's chappal went from, say, roughly 80, 90 rupees to 160 rupees. And the
Mhm.
chappal, the doodh ka packet wala guy also entered. Relaxo lost market share. We obviously met them. We discussed the issue with them. They explained to us what they had done. But by that time, market share loss, revenue stagnation, etc., had kicked in.
But they would have
And
experienced this long time, many times in the past, right?
no, so in the past, they had done what great franchises do, which is hold your nerve when the input cost goes up, right? For a bunch of reasons that I'm not fully aware of. This time around, they decided to jack up their end product prices to coincide with to jack up their end product prices to maintain their
Mhm,
profit margins, right? Now, to give them credit, they were trying to keep the stock market happy by saying, देखिए हमारे पास pricing power है, we protected our margins. But that's not how successful franchises think. And where I blame myself more than anybody else, I blame myself. We should have been more vigilant about the fact that the franchise was growing rapidly through 2020, 21. It was becoming more complex, larger, harder to manage. In the post GST world, the use of
mhm,
technology by other footwear manufacturers was growing in auto replenishment system, use of SAP, and so on. And
Mm.
perhaps had we been more vigilant, we could have spotted these issues quicker rather than waiting for the strategic error to kick in and then belatedly us getting out. We made a very healthy return on the Relaxo investment over the 6 years we were in it, but the last 7, 8 months of that could have been avoided had we been a bit more vigilant in 2021.
So what steps do you take to avoid such, these things can't be ruled out because things will be like this. You'll keep getting surprises from a company which historically has been a very credible and a very impressive player.
Yeah, so if you think about it, right, the the deeper mistake is when a company's results are good, and Relaxo's results were spectacular, not just through COVID, through 2021 as well. Results were very good. So the deeper mistake is when a company's results are good, the tendency is to relax, to say, सब अच्छा तो चल रहा है, number अच्छे आ रहे हैं. And what we have learned the hard way, and even today I was discussing with my colleagues, is uh, quarter after quarter, we need to deepen our understanding of those two aspects I was mentioning. Leaving aside the moat, quarter after quarter, we need to deepen our understanding of the quality of capital allocation, the quality of succession planning. So here, if you sort of think about it in that framework, effectively when we are saying is that we need to see professionalization of management, we need to see succession planning, high quality executives who have run large footwear enterprises or have done sales and marketing in large B2C setups. We would have expected to see them being brought into the picture. We've learned the lesson the hard way that even when results are good, you need to keep pushing yourself to see, is the company strengthening itself on capital allocation and on succession planning, especially if the company is growing leaps and bounds. So just to sort of give you an example of how we learned, after learning from Relaxo, we very promptly went to GMM Fodler and said that, look, you've gone from being a Indian company to now Fodler, you're now a global enterprise. You've got offices in 10 countries, factories, I think in 8 countries. You're a multinational. The way the business was run as a India-only enterprise cannot work on a global basis. And therefore, top quality management, top quality board, can you please think about it? And to give credit to Tarak Patel and the Fodler management, they responded to that. They brought new people to the board. They brought top quality people from MNCs to the C-suite of Fodler.
Does it not really change the character or the culture of a company which has been evolving based on loyalty? It's a pole vault company.
It does, and in a way, that's the evolution a company needs to go through. So so we're working on Unusual Billionaires 2 at the moment. So it's a lot of fun to go through this. Let me not give away the names of the companies in Unusual Billionaires 2. Let me go back to Unusual Billionaires 1 for an example of how a company changes, right? As a company scales, naturally new systems and processes have to come in. Usually, alongside those new systems and processes, you have to bring in the talent that can run those systems and processes, right? Secondly, as a company scales, the original CEO/founder, he ages or she ages, and there's a biological passage via which he or she also has to gradually exit, right? And what you or we are looking to do is study, is the arrival of new talent and the succession planning that the aging promoter is doing, is that strengthening the franchise or weakening it? And this is actually a big part of our job, especially in the consistent compounders, right? So, for example, one of the meetings we insist upon doing is we want the CEO and his one downs or her one downs in the same room, and we will discuss matters of strategy. And what we will see is who answers the questions. If every sawal is being announced, is being handled by the CEO, and the one down is a mute spectator, then that's very telling. On the other hand, if the one downs, head of strategy, head of finance, head of HR, if the one downs are answering the questions without even looking at the CEO, right, without looking for a visual Haji bolo up, right, that's very telling, right? So as companies scale, they have to strengthen systems, processes, people. Are they doing that? Are they strengthening or are they weakening? Are they losing their core identity? And secondly, as the promoter ages, as the first generation management team at HDFC Bank aged, as the Bhaskar Bhatt era and Titan aged,
Mhm.
did they leave behind a stronger management team or a weaker one? I think that those sorts of questions I think are at the heart of successful investing.
The HDFC and the Titan are wrong example because they were not a family run, or they were not promoter led companies as compared to the Relaxo or GMM Fodler or any other company where the family and the professional management and the handing over may not be smooth, or there could be a big cultural shift or the migration.
Right. So in HDFC Bank's case, whilst the great Aditya Puri was there, the
Mhm.
market used to think he's the be all and end all, and there was huge concern that Aditya Puri will go. What will happen when Sashi Jagdishan comes? Hopefully, those who used to worry about such issues were no longer worried, given that over the last 5 years, Sashi and team have done a stellar job. So my view is a lot of it is optics, rightfully or wrongfully. People associate large franchises like HDFC Bank with Aditya Puri ji, Titan with Bhaskar Bhatt Saab, right? But let me answer your question in the spirit you asked in it. Let's look at a small company where the promoter stepped back, right? Dr. Lal Path Labs. Dr. Lal stepped back around 15 years ago, and Om Manchanda was bought in. Om then bought in a high quality professional team. They are the people who have scaled Dr. Lal Path Labs spectacularly over the last 15 years, the first large scale organized path lab in the country. The promoter remains the largest shareholder, in fact, a majority shareholder.
Mhm.
The company carries his name, but he does not get involved in the day-to-day running of the business. A high-quality professional team runs it. Had Dr. Lal not stepped away, had Om not built the company out with professional management, modern technology, I doubt Dr. Lal Path Labs would be what it is today. That's the kind of change that we need to see other small cap, mid cap firms
Well,
make.
because I'm based in Delhi and this is where the company started. I know that this whole start of Dr. Lal's expansion with a professional manager
Mhm.
from being a one diagnostic center in Connaught Place
Yes.
was a big
Yes.
leap. And this was first they sold it off to a private equity, and then they reversed the transaction, and then he went about getting a professional manager. So, to begin with, Dr. Lal's the larger footprint or the implementation of the business plan was actually with a professional management. There was no migration here.
Right. So you're saying at the outset he bought Omen, and that's how the journey kicked off. So fair enough. He could have been a promoter who interferes day to day with Om's management. He
That is
didn't do
what he
that,
did
right?
all his life. For 25 years, he ran a diagnostic center, and then he thought that now I have to expand. Let me hire this guy, and
Right. Very
then
few. So Dhirendra, I appreciate the fact that Dr. Lal hasn't interfered in
yeah,
Om Manchanda's build out of of the Path Lab business, but most promoters struggle to stay away in the way Dr. Lal has. Let's take another example, right? Let's take Marico with Harsh Mariwala ji
yeah,
stepping
yeah.
away and Shogoto becoming the MD. What was a decade or so ago? I think decade or so ago, Shogoto became the MD, and it was done very thoughtfully. I've described this in Unusual Billionaires how Harsh Mariwala ji thought through Shogoto's taking over as the of the business, and yet it's not as if Harsh has abdicated. He hasn't said Shogoto jo marzi karo. There is a check and balance, but Shogoto runs the business. Harsh Mariwala is the promoter. Kuldeep Singh Dhingra and Berger Paints. Right?
Yeah,
Kuldeep Singh
yeah.
Dhingra is based
Might
in
be a correct
Delhi.
example. Yeah.
The Berger Paints management, and I think since Dhingra Saab bought Berger Paints in 1990 or 91,
Mhm.
there's been three generations of CEOs, and they've scaled the company. I mean, this company has compounded something like 2000x in the
Hmm.
last 30 years under three different CEOs, same promoter, three different CEOs. This is a real art.
Yeah.
This is a real art. Pidilite and Bharat Puri ji, right?
Mhm.
Madhukar Parekh ji built it, ran it. Bharat Puri ji took over a decade or so ago. Again, it has scaled very successfully. This aspect, right? Roughly $1 billion to $3 billion market cap.
Mhm.
8,000 से 20,000 करोड़ इसके बीच में between 8,000 and 20,000 crores is when the inflection point kicks in, and it's a tough inflection point. It's hard for the original founder to step away. It's
Mhm.
hard for a new guy to come into the giant promoter's shoes, take charge and scale the business at 20-25% per annum thereafter. But that's in a way part of our job description to get companies right through that transition.
To that cycle. Okay. Though I disagree with some of your example because Marico, no, Harsh, Mariwala actually created Marico as a professional company, and he split out of his family business from a traditional commodity oil business to this, which is written
Yes, he did. Yes, I agree.
which
I agree.
so it from day zero it was a professional company, and that is how we started, getting a team from the business school and delegating it, and and all the stories that how the Marico packaging of that, the parachute plastic ones.
Absolutely. So
um,
that's in a way, that's exactly what we look for when we identify a small cap, right?
Mhm.
With the passage of time, we've realized that it helps to look for promoters who have the right habits, because as the company hits 2 billion, 3 billion, 4 billion, we can then make a call on longevity. And
Mhm.
that's where I am chastising myself for not having thought that through as clearly as we should have on Relaxo.
Mhm.
And yet on Dr. Lal, we thought it through. Perhaps we were lucky that Dr. Lal and Om had created the right chemistry.
Characters
But
and
like,
attributes of scalability is
that's
primary.
right.
Okay. uh, I'm moving to another very crucial question, that can you recall a situation where you initially thought that you made a big mistake, but it turned out to be a bonanza, or a multi-bagger, or something which you discovered on the way?
And so, why don't I describe a big mistake, which
Mhm.
subsequently became a bonanza? So, we've been looking at Trent now for the best part of 10
Okay.
years, right? So, there's a west side close to where I stay in the suburbs of Bombay. So, I've been visiting it. I saw firsthand the Purana west side kind of being dismantled and the new west side format being built.
Mhm.
I saw west side getting busier. I saw Trent do the JV with Zara, which has been very successful. I
Mhm.
saw my wife and my daughter become fond of Zara clothes. I saw all of that, but we didn't buy the stock. Every time we would meet management, whether it was the erstwhile CEO Philip Old or the chairman Noel Tata Saab, every time we would meet them, we would say, your affordable clothing format doesn't make money. We would say Star Bazaar paisa nahi banata, and we
Mhm.
would say all these profits that you make
Mhm.
in Zara and West Side, you fritter it away elsewhere, and we therefore can't buy the stock. And they would say, "You guys do what you think is right, right?" So ये सब हमने किया. Uh, Through COVID, we realized before COVID that they were launching Zudio.
Mhm.
Through COVID, in the aftermath of COVID, through 21, through 22, we kept visiting Zudio stores. We kept asking other people. They started saying good things about Zudio stores. Even through 2022, we couldn't muster the courage to buy Trent, saying that Zudio to barely profitable hai. Will
Mhm.
they scale this successfully? Pata nahi. Um, it's only in the early part of 2023 that we started realizing that Trent not just has West Side, not
Mhm.
just has Zara. Zudio is now turning profitable. Zudio is scaling. We visited Zudio stores in many parts of the country, and then somewhere around July, August, Dhirendra, we realized that Star Bazaar भी पैसा बनाएगा. अभी नहीं बनाता है, but we realized Star Bazaar is on the cusp of
Making money.
profitability, and it's a new format grocery store, very different from the DMart format.
Mhm.
But this is a format which we figured out after many different store visits will work. And I think August was when Marcellus finally made the investment in Trent, right? So, had my colleagues and I had greater foresight, we could have made the business investment 10 years ago and, made a multi-bagger in that period. But better late than never, we reckon this company will go on to become a multi-bagger. And that's always the challenge in our style of investing, right? How much proof do you need to see of execution before you commit your customers' hard-earned money to that stock? Obviously, with a company like Trent, there's no issues around governance or accounting.
Yeah, if you would
What
have
we're
made
trying
that investment 40 years ago as Lakme, you would have still made a lot of money.
Absolutely. So 40 years ago, unfortunately, I was in primary school. Yeah, 20 years ago, I wasn't in the country. 15
I
years ago,
remember, when Trent was, when it was Lakme Limited, sold off
right.
the brands, and it gave a 3,000% dividend or so in
Right.
subsequent years. And that is when Simon Tata actually retired.
Right.
So looking at the history, you never go wrong with such a group, or at least the corporate governance is
Nicely put.
not
So
maintained.
so that's your wisdom speaking, and in a way, that's what we are trying to teach ourselves. As you hit the nail upon the head. If you look at the history of a company, it tells you a lot. And we insist that our analysts do at least 10 years of history study But as I get older, I realize even longer term history, 25 years history study also works. And ironically, a lot of people think the stock market is about predicting the future.
Mhm.
And the older I get, I realize it's about studying the past.
Now I'm getting to the hard question,
Right?
and I
Okay.
hope it is not an embarrassing question. How do you deal with underperformance? I saw that recently your funds have not done well. You are so transparent, and everything is out there. How do you handle the pressure that comes with underperformance? Has it caused a difference in your style?
So our funds actually haven't done so well. So that's the first part of why
Yeah.
it's not so hard. So
Mhm.
the flagship product has compounded at 27% this fiscal ahead of the market. That's where we run close to $1 billion. In fact, the performance there has been so solid that the foreign inflows are coming in. The FII inflows are coming in largely around that theme. Our mid-cap product had an awful 2022.
Mhm.
All our products had an awful 2022. Our flagship product has recovered very strongly in the current fiscal. The mid-cap product has also recovered pretty decently. I think last 12 months, the mid-cap product is up 22-23%. Not as much as the market, but a solid recovery from the absolute pounding we took in 2022 in the mid-cap product. Our financials product, Kings of Capital, has also had a decent run in the last 12 months. I think it again up in the high teens or low 20s. The only product where we've had a really difficult time in the last 12 months is the Little Champs, the small
Mm.
cap product, where as we were discussing, courtesy the Chinese dumping,
Mhm.
the companies which have export-oriented franchises or franchises which are producing products that the Chinese also produce, they've had
Specialty
an
chemical, particularly.
specialty chemicals, or even say a company like Poshak, which creates phosgene derivatives for the agrochem market.
Mhm.
And I've learned through life that you're not going to have every year is not going to work out. So
Mhm.
remember Little Champs, these companies market cap is typically 5,000, 6,000 crores. They've had 5 tremendous years of profit compounding. Profits are compounding for the Little Champ companies up at around 23, 24% through the last 5 years. And therefore, the first 6 months of the current fiscal, profits falling by 2, 3% at the aggregate level, at the portfolio level, is not particularly surprising. Um, I don't really lose too much sleep about the what others say. Our job is to make sure that we invest in companies where the profits compound at a decent rate. The share price will follow.
The thesis is
Um,
intact.
yeah, as long as the business continues to be
Mhm.
intact, the share price will follow. As I was saying, at some stage, the Chinese will stop dumping.
Mhm.
At that stage, these companies' profits will blast through the roof. I can't sort of say I'll sell now and buy the day before the Chinese stop dumping, because I don't think the Chinese are going to give me a phone call to say अब हमने बंद कर दिया dumping, अब आपके companies के results अच्छे आएंगे. So कुछ तो लोग कहेंगे, उनका काम है कहना. We carry on. It doesn't affect us that much. It affects some of the clients. They get jittery when they see negative headlines. They call us up and we say, look, I mean, this is what it is. Here's the performance, here's the portfolio. If you're up for the right of investing in high quality companies to compound profit, small cap profit compounding at 25% for small companies year after year is not easy. If you stay with us, you stay the course, you'll make money. Little Champs 4.5 year track record net of fees is 18%.
Mhm.
If you stay the right, net of fees, you'll make high teens return.
Mhm.
If you want to panic, entirely up to you.
Mhm.
But what our upbringing and our education has given us is this focus that we have to stay invested in clean companies, good governance, steady track record, and deep comparative advantages. So ये इतने साल किया है, it's
Mhm.
second nature to us. So what other people say doesn't really
You are staying the course. Okay.
matter. Yeah, it's not even hard to say the course because यही आता है और कुछ तो
Yeah.
आता नहीं है.
Mhm. Uh, Now another question, which, your big positions, Asian Paints, Trends, of course, you discussed in great detail, are being referred as, this very interesting Bob stocks in social media, buy at any price. And, you
So,
know,
I mean, I wish people did that, then we wouldn't have any problem with them. But I understand what people say. Again, we focus on the business. The business continues to compound.
but is there any kind of feeling to the valuation framework that you follow?
So remember, our job is not to lose sleep on the PE multiple, right? So if you just let's take Asian Paints, it's actually the simplest way to explain this point. It's very easy to do. If you go out and dig out profit compounding data on Asian Paints, it's pretty steady. The profit compounding number is pretty steady around the high teens mark, and the free cash flow compounding figure is pretty steady around the 20-22% mark, right? Last 2 years, ironically, profit compounding has been spectacular for Asian Paints. They initially got hit in that 2022 input cost surge, but obviously, as oil prices have come off, their profits have bounded up. But Asian Paint, the profit compounding picture is incredibly steady. It's a line sloping at the high teens, so the cash flow compounding figure slopes at low 20s. Naturally, Devendra, the PE multiple oscillates around that. The PE multiple oscillates around that, right? That's what you're expected to do. Why would the P and the E go in a straight line? It doesn't do for any company. Now, what a lot of people contend is, जब P ज़्यादा होगी तब आप बेच दो, और जब P कम होगी तब आप खरीद लो, right? So that's the point of view, and this is a lot of people believe this is called they believe this is called value investing.
Investing.
Now, there's a couple of problems with this notion. जब P ज़्यादा होगी तब बेच दो, और जब P कम होगी. The first challenge is, P mean reverts, everybody knows, but nobody knows the timing of the mean reversion. So just to take Trent's case, supposedly Trent is trading at 170 P, right? That's what I get told. In our models, it's not trading at 170 P because our expectation of E basis our work is very different from the Aam Janta's expectation of the E. So you have different notions of P at a point in time. When exactly that PE will mean revert is not known, both on the way up and on the way down. Right? That's the first challenge on this whole notion of
The way you are
PE.
discounting the future is actually justifying it.
Right? So the way you see the future, right? We believe Star Bazaar will be a major driver of Trend's profits. Other people are not seeing it as such. We believe in Asian Paints' case, the home decor business will be a major driver of profits. Other people are not seeing it as such. Therefore, our perception of E itself is different. Because the perception of E is different, our perception of P is different, right? And a market is made when different people have different points of view on the stock. But let's get into an altogether different issue as well. So suppose on Asian Paints, I had perfect foresight and I sold 2 years ago. And I have perfect foresight and I buy whenever it'll go up again, right? We've shown this quite comprehensively. It's very easy to do on Asian Paints. If you have two investors, Mr. Gifted, who buys बिल्कुल P नीचे होता है and who sells Asian Paint but बिल्कुल P ऊपर होता है. Mr. Gifted does this over 20 years, and Mr. Mottle, who doesn't have any idea about any of this, so every year he buys Asian Paints on 1st January. हर साल वो 1st January को खरीदता है क्योंकि वो बोलता है मेरे को तो पता नहीं कब पी चढ़ेगी गिरेगी. It's very easy to show Mr. Mottle outperforms Mr. Gifted sustainably.
Okay.
Mr. Mottle outperforms Mr. Gifted not because Mr. Mottle has got sixth sense, but because the underlying compounding of the business overcomes the oscillation in the P. Now, this sort of wisdom only dawns upon people like me after I've lost a lot of hair trying to do investing over the last 20 years.
You haven't lost much hair.
नहीं सर, वो सामने से दिखता नहीं है, but anyway. But for someone who takes investing superficially and believes this PE multiple game is the way to go, they live and learn. It doesn't work. Furthermore, in our books in Coffee Can Investing and in Diamonds in the Dust, I've shown that the PE multiple has zero predictive power. Right? Companies with high PE go on to do well. Companies with low PE go on to do badly. In fact, some of our best investments have been made when the PEs have absolutely been through the roof. So, for example, we trebled our position in Bajaj Finance in May 2020.
Okay.
Right? You can imagine, right? The forward PE on Bajaj Finance in May 2020 must have been, skyrocketing because nobody expected Bajaj Finance to. Right, exactly, right. Some of our position size ramp up and tighten also came as COVID wore on, and analysts kept cutting their earnings estimates for Titan, and the PE kept ramping, right? So this is one of the most destructive notions in investing. I love it when people, say all sorts of rude things, because as Henry Kissinger said, there is no such thing as bad publicity.
Okay. No, this is new for me. You have learned business quite a bit since the day you started. Yeah. So when do you sell? when it actually becomes a clear absolute sell in your context, in your framework?
So three sorts of sell signals that we've seen come through quite nicely. Firstly, when capital is not being allocated sensibly, right? And that's reasonably clear. If you read annual reports, speak to management, you can see misallocation of capital. Second is when succession planning isn't quite working out. Either there's a lack of succession planning, or the successor who's been identified is not up to the task. And the third is when lethargy kicks in, when the management team or the owners are very happy with their success, they're enjoying their wealth, spending a lot of time on the golf course rather than working in the factory or in the office. These are the three sell signals. Um, the whole aspect around valuation plays a role in ramping up and ramping down the position size. So obviously, when Bajaj Finance went through the roof in 2023, we cut the position size down, right? When Bajaj Finance got smashed in the first 4 months of COVID, we ramped the position size up. When Divi's Lab halved through 2022, in early 23, we ramped the position size up, right? So valuation is a driver of position sizing. The sell signals are capital allocation, succession planning, and lethargy.
So, in your view, when does a company start losing its way?
When does a
All
company
these
start
fronts,
losing its way?
capital allocation or drifting or
Right.
lethargy, all the things
So,
that you said?
so if you, in a way, you've already picked up one of the key factors, right? That transition from the original founder or founding team to the next generation. If the next generation isn't up for the challenge, right? Om Manchanda was wonderfully up for the challenge, and Dr. Lal has benefited because of that. But more often than not, these transitions tend to be very troublesome, right? In fact, I'll be honest, because we were so apprehensive about how Titan will perform after the great Bhaskar Bhatt retired, we waited for the new management team to settle and show their true colors before we invested in Titan, right? So the first area a company can lose its way is when the transition takes place from the first gen to the second gen management team. Second is success, surplus cash flow, the arrival of investment bankers in the boardroom, M&A, and that typically ends up being a trigger for poor capital allocation, right? And the third is entrance of deeply disruptive new players who are either coming in from the Western world or coming in from the startup VC ecosystem with profoundly different technology to what the incumbent has.
Couple of more questions, but I think in the context of answering other questions, you have answered them in a very meaningful manner. Which was, is it more challenging to continue holding on to a big winner or a big loser in your experience? Which you said, the Relaxo and the Trent example amply illustrates that. How do you stay patient with your, with your clients' demand every other day?
I think the credit for that, Dhirendra, shouldn't go to me. It should go to the other founders in Marcellus. They deal with the client. They deal with the client with immense fortitude. I think, as you already highlighted, the media creates a lot of noise, and people get worked up around that. So huge credit to my fellow founders for dealing with the whole aspect of managing emotions of the client base. And also huge credit to my fellow founders who actually do the hard work of meeting hundreds of companies, meeting thousands of primary data experts, collating it all in a structured framework, and day after day running these portfolios with very little churn, right? Our churn ratios are in consistent compounders, we barely buy one stock every year. That means the typical stock stays in the portfolio 7-8 years. Staying patient in India through all the drama around politics, stock market, interest rates, Russia, Ukraine, all of that is takes immense mental fortitude as well. So a big part of this job plays out in the mind, whether it's in the mind of my colleagues who deal with our clients and their emotional ups and downs, or in the minds of our fund managers who deal with the mental turbulence that global macro and quarterly results can cause.
What is the headcount now? Sales, research, and operations?
So 100 people Marcellus has.
100 people. You don't aspire to become a mutual fund company, asset management company. Of course, you are managing assets, but a mutual fund license?
I think we are happy with the PMS construct. I think the regulator has done a terrific job by reforming and improving the PMS construct. So SEBI's PMS regulations 2020, I think, have been instrumental in the PMS industry getting a breath of fresh air. I have to say without any hesitation, PMS Regs 2020 has been a significant part of Marcellus's success.
Mhm.
I was part of that working group which contributed to the consultation paper which the regulator used to reform the rules. But I think the PMS industry has been made transparent. It's allowed
No, but purely from
invest.
a customer's point of view, that becoming a more tax efficient vehicle.
There is tax efficiency, but there are aspects of the PMS industry where the MF doesn't have. So, for example, we can run highly concentrated 15 stock portfolios. That's our house style. We don't think adding lots of stocks to the portfolio gives you any further diversification. 15, we think, is an appropriate number for large caps. You can't do that in a MF. Secondly, Dhirendra, the bulk of our clients pay us on performance, right? So the bulk of our clients have zero fixed fees, and we get only paid for performance north of a hurdle. Typically, the hurdle is 8%.
Okay.
Again, we can't do that sort of structure with
Mhm.
MF. So the MF industry is a lot going for it. The industry is clearly growing, great grants. Maybe at some stage in the future, we'll explore an MF license. But at this stage, we're a small firm. We
Mhm.
manage 10,000 crores of assets, which in the context of Indian asset management is nothing.
Mhm.
So there's a vast affluent, increasingly affluent middle class, upper middle class for us to cater to, and we're focused on servicing them. Maybe at some stage when we outgrow the PMS market, we might think about the MF license.
You'll be looking at active managers in the mutual fund arena, and do you think there is any big problem, or they lack conviction, they are not backing, they are not courageous enough, any such thing?
No, I don't think that's the case. I mean, I think like in any industry, like in any country, so if you look at data for American mutual funds or data for Indian mutual funds, naturally in large cap equities, it's hard to beat the market over a 5-10 year horizon. I think
Mhm.
it's really hard in America. Probably I don't have the figures to hand, but I doubt more than 5% of American large cap fund managers beat the S&P 500 over 3, 5, and 10 years.
Mhm.
And from what I've seen of the Indian numbers, the ratios in India are 10 to 20%, right? So that's the nature of a competitive, efficient market, that only a small minority of managers will beat the large cap indices. It's relatively clear that in small cap equities in the MF industry, the number of fund managers who can outperform is greater, right? But the challenge I find there in small caps is, whilst the proportion of fund managers outperform is greater in small caps than large caps, there's very little persistence in the data. So the fund managers who outperform in the latest 2 to 3 year cycle are not the people who outperformed in the previous 2 to 3 year cycle. And that in a way makes it very difficult from the end investor's perspective as to which small cap fund to go with, which is where publications like Wealth Insight come in very handy for the
Mhm.
public, right? So I think the Indian mutual fund industry has grown leaps and bounds. I reckon it will carry on growing. Financialization in India is an epic story that will play out over the next 2, 3 decades. All of us will benefit from it. Perhaps the mutual fund industry will grow at certain periods of time faster than the PMS industry. But if you take a decadal look, I think PMS and MF assets will broadly grow at the
Mhm.
same rate.
Uh, what are your thoughts on, grow now, profit later, this, the culture with the new age companies, and, it is actually having a bearing on other businesses too.
No, I think this is not the culture of specific to India. I think this is a culture which has been brought about by cheap money arising in America. That money in turn arose from the aftermath of the great financial crisis,
Mhm.
which meant that the Federal Reserve had to pump initially $3 trillion into the into the US financial system to keep the American financial system afloat. And then the wild money printing by the Fed during COVID. Even when it was happening, I thought it made no sense. $10 trillion is roughly what the Western central banks printed in 2020. That obviously gave a further fillip to it. Uh, unless something as crazy, as traumatic as Lehman and COVID happens again, Dhirendra, I
Mhm.
don't think this is a sustainable state of affairs. We've already seen that the $10 trillion printing frenzy by the Western central banks uh, contributed to the 9% inflation through 2022. Um, and quantitative tightening, on the other hand, has throttled off inflation. So I think the lesson hopefully has been learned by Western central banks. If that's the case, then I don't think we'll get a return to that wild, where somebody gives you sabji for free and delivers it to your house in 5 minutes. And we'll remember that phase as a freak phase in capitalism.
Now, getting to just two questions beyond investing. On a personal level, what are your thoughts on all the global problems that we see? Russia, West, split, China, Taiwan tension, climate change. Does it really, these concerns weigh your mind?
So as a citizen, as a
Time too?
human, as a citizen, as a human being, as a father of two young children, obviously I worry about these issues. It doesn't help. Every summer feels hotter than the one before. Uh, and if you feel that even more acutely when I go to the UK to meet my parents. UK summers are insanely hot now. The 18 years I lived in the UK, I think must have switched on a table fan 7 times. Now every house in the UK has table fans through the summer, and summers are insanely hot. In the UK, people die of heat strokes. In Europe and America now through summer. So you can see the world becoming a frying pan every summer. In India, we see the monsoons becoming more violent because obviously the hotter it gets, the more violent the monsoons get. And we see parts of the country being washed away, whether it's Uttarakhand one year, Himachal the next year. So you can see there is a problem. As a human being, you worry about it. I'm not so sure what I can do about it as an individual. I contribute to a few charities in my modest personal capacity. As an investor, what we have tried to do is realize that these sorts of shocks, geopolitical shocks, climate-related shocks, will become the norm. We can't second guess the shock. कौन सी युद्ध अगले साल होगी पता नहीं मेरे को. I can't second guess the shock. What I can do is focus on companies who are incredibly robust, financially strong, level-headed promoters, so show rational and judgment in running their business. I suspect that played a part in the fact that we outperformed so strongly in those 2 years of COVID, right? So that
COVID, okay.
First 6 months of COVID, when the market fell 30 odd percent, we fell 15, 20%. Some people will say that's lucky, but I'll say that the fact that the portfolio is built with Nestle and HDFC Bank and Dr. Lal Path Labs and Asian Paints is not an accident. It goes back to the books that we have discussed in the philosophy, and therefore, in times of stress, more often than not, we will come out with better numbers. How
much time you spend on reading Wealth Insight? You just mentioned in the last.
So you used to send it. You used to send it every time the publication came through. After COVID, I think for good reason you stopped sending it. But I'm a frequent visitor to the website now, given that I don't get the physical copy anymore. I'm a frequent visitor to the website, and thank you very much for carrying my columns. I don't know if you remember, Dhirendra, you first reached out with your request for me to write 10 years ago. So it's nearly a decade.
That was before Marcellus, many years before Marcellus.
And before Unusual Billionaires as well, actually.
Yeah. Before.
So thank you very much for reaching out.
That would have been your regular writing assignment, so to say.
Yeah, that was my first regular writing assignment. So thank you very much for giving me that.
No, most welcome, and we enjoy. I wish you write some exclusive thing for us, though it's asking for too much. But one more, the last question: life outside of investments. Do you have hobbies? Do you envision retirement or exploring different pursuits in future?
So the main area that I'm very interested in is education. So part of the reason I write and part of the reason we write so much, not just books but also newsletters, write in Wealth Insiders. I've always believed that a big part of a professional's life should be not just enriching himself financially, but also doing what one can to spread the word about whatever it is that one is strong in. When I look around the world, when I travel around India, especially amongst young men. I think young Indian women are finding their way in the world just fine. I think we keep writing stuff and we'll write more stuff. The rise of Indian women is astonishing. The rate at which Indian women are skyrocketing towards prosperity is astonishing. I think there's a real challenge with Indian men, getting them educated, getting them employed. And when life permits me, I'll perhaps do more about that. Until then, I try to donate to causes which are helping with skilling and employment. I think more than global warming and more than geopolitical issues, getting young men educated, skilled, and employed is a massive challenge for India, and I want to do my 10 cents to remediate that challenge.
Thank you very much for this enriching interaction. And
Thank you.
I hope it proves to be a value for your time as well.
Thank you so much, Dhirendra. Thank you for this opportunity.
Thank you very much for this taking this time off for this.
My pleasure. Thank you, sir.